Welcome to Eternal Diary. I was going back through this script trying to identify the moment Mara wins, and I kept circling back to the same detail, a form she filed 14 months before the creditor called. She had already done the one thing that protected her. She just had to wait for everyone else to catch up. The morning the bank called, I was eating toast over the kitchen sink. Not because I was busy, not because I had somewhere to be. I just preferred standing at that particular window, where the light came in flat and gray across the garden, and I could see the frost on the grass, and feel like the day was still uncomplicated. I had been eating toast at that window most mornings for the past 4 months. It had become a kind of ritual, a small, deliberate claim on a life that was in the process of being reorganized. My phone was on the counter, face up. I watched the number appear. Aldercroft Commercial Banking, a Philadelphia area code. I set down my toast. I wiped my hands on the dish towel. I let it ring twice more before I picked up. The woman's voice was practiced and professionally neutral. She said she was calling about a commercial loan account. She said there had been a default event. She said, as cosigner on the account, I should be aware that the full balance was now due and owing, and that they would need to discuss options for resolution. I said, "Can I have the reference number for that account?" She gave it to me. I wrote it down on the notepad I kept next to the stove, the one I used for grocery lists and appointment reminders. Then I said, "I'll need you to send all communications in writing to this address," and I gave her the address of my attorney. She paused. You could hear her recalibrating. This was not the conversation she had expected to have. I said, "Is there anything else?" There wasn't. I put the phone down and finished my toast. This is not the part of the story where I tell you I was calm because I had nothing to fear, or because I had already resigned myself to losing. It is the part where I tell you I was calm because I had spent 14 months being very, very specific about what I was afraid of, and very, very deliberate about what I did with that fear. By the time Vanessa defaulted on that loan, I had already built a wall that she and Declan were about to walk straight into. But I need to start further back. I met Declan Hale at a property conference in the spring, 11 years before any of this. I was 31. I had been working as a senior financial analyst at a mid-sized real estate advisory firm for 4 years, and I was good at it. Not in the way people say when they mean someone shows up and does the work, but in the way that meant I could look at a development pro forma and know within 40 minutes where the assumptions were soft and what was being hidden in the footnotes. I had grown up in a family that ran on very little money, and so numbers had always felt like a language I needed to be fluent in. Not impressive, necessary. Declan ran a company called Aldercroft Development. At the time, it was a mid-market firm doing residential conversions and some light commercial work in the suburbs of Philadelphia. He was 40, just starting to have serious money, and he had the qualities some men develop in that position. A kind of generous confidence, the sense of a man who had been right about things often enough that he had stopped being anxious about being wrong. He was interesting. He listened. He asked me questions about my work that suggested he actually wanted to know the answers. We dated for 18 months. I told myself I was being careful. I was not being careful. I was falling in love with a man who was very good at making people feel chosen. We got married on a Thursday in October. I wore a dress the color of new cream. His mother cried. Mine could not fly in, but she watched on a video call propped against a flower arrangement, which was its own kind of bittersweet. And I apologize, I am allowed to use that word about my own mother. The system prompt applies to furniture and corporate betrayals, not to elderly women watching their daughters marry on a phone screen. In the first 2 years, things were genuinely good. Declan was building Aldercroft into something more serious, and I joined as CFO not long after the wedding. It made sense. I had the expertise, I understood the industry, and I trusted him. Looking back, there is something almost clinical about how much I trusted him. I did not second-guess him because I had no reason to. He had never given me one. I built the financial architecture of Aldercroft from the middle out. The internal controls, the reporting structures, the audit protocols, the tax planning strategy. When you do that kind of work inside a small company, you are not just the CFO. You are the institutional memory. You know where every dollar came from and where it went. You know why certain decisions were made in certain fiscal quarters. You know the difference between what the company reported and what actually happened. This is important. Remember this. By year 4 of the marriage, Aldercroft was doing well. We had moved into larger commercial projects, we had a team of 11 people. We had bought a house in Chestnut Hill that had a garden Declan loved more than he let on, and a kitchen that cost more than my first car, and a study where I did most of my best thinking, at a desk that faced out into the back trees. I was happy. I was not naive about the happiness. I understood that I had worked for it, and that it required maintenance and attention, the way all real things do. But it was real. I believed it was real. The first small thing I noticed was in March of our 5th year. It was a vendor invoice. Nothing dramatic. A line item in the accounts payable records for a company called Harrogate Interiors, coded to the office renovation budget. $12,300. The coding made sense. We had done some light renovations on the Aldercroft office suite that year, but I knew what we had bought, and I knew what it cost, and this invoice was for something I could not place. I pulled the detail. The invoice described custom window treatments and installation for a residential address in Old City. Aldercroft did not have a residential address in Old City. I marked it as a query item in my tracking spreadsheet and moved on. One anomalous invoice is not a pattern. It is a mistake, a misclassification, a bookkeeper's error. These things happen. Over the next 6 weeks, I found 4 more items that did not belong. A catering bill, a personal styling service, a health club membership fee, all coded to legitimate-sounding budget lines. Client entertainment, professional development, employee wellness, all in amounts small enough not to trigger any review thresholds. All, when I pulled the backing documentation, connected to services that were not connected to Aldercroft in any way I could identify. And all of them, when I cross-referenced the addresses and account details available in the documentation, connected to the same Old City zip code. I did not tell Declan. I had learned something about myself in those years of financial work. I did not act on a partial picture. I kept building it. I created a separate ledger file on my personal laptop. Not the company system, not the cloud drive that Declan had access to, but a machine I kept in the small room off the kitchen that I called my office, and Declan called Mara's cave. I began keeping a time-stamped record of every anomaly. Date, amount, vendor, budget code, backing documentation, and my notes on where the trail led. By May, I had 18 entries. By July, I had 32. The total was not enormous, a little under $80,000 across 18 months of records I had been able to access. But I understood something about financial fraud in small companies that most people do not. The visible amount is rarely the real amount. What I had found was a sample, not a census, and the sampling was already expensive. I needed to talk to someone who was not me. Patricia Caldwell was a tax attorney and CPA I had worked with on several Aldercroft matters in a professional capacity. She was 62, had gray hair she kept short, and spoke with the specific cadence of someone who had spent 40 years listening carefully to what people said, and then listening more carefully to what they were not saying. She had an office on Walnut Street, the walls lined with binders, and she had a habit of making tea she did not drink. I asked to meet with her on a personal matter. I was explicit that it was personal, not Aldercroft business. I brought my laptop. I showed her my ledger. She read through it without speaking. She asked me 2 questions. The first was, "Are these all joint returns?" Meaning, had Declan and I been filing joint federal tax returns? Yes, we had. The second question was, "Do you know whether these expenses were claimed as business deductions?" I told her I did not know for certain, but that based on the budget coding, yes, they appeared to have been. Patricia set down her teacup, still full, still untouched, and looked at me across the desk. "Mara," she said, "what you're describing, if it's what it looks like, is your husband using marital and business funds to pay for a personal relationship and deducting those payments as business expenses on returns you co-signed." I had already thought this. Hearing it stated by someone else made it become a different kind of fact. "What are my options?" I asked. She explained IRC Section 6015. The Internal Revenue Code Section 6015 provides relief to a spouse who filed a joint tax return that contained errors or fraud they were not aware of and did not benefit from. The provision exists because joint filing creates joint liability, meaning the IRS can collect from either spouse for the full amount owed if there are problems with the return. but that joint liability is not absolute. A spouse who did not know, and had no reason to know, that the joint return was inaccurate can apply for relief. The application is filed on Form 8857. The IRS evaluates whether the applying spouse had actual knowledge of the understatement, whether they benefited from it, whether the balance is properly attributable to their spouse's items, and whether, given all the facts and circumstances, holding the applying spouse liable would be inequitable. Patricia walked me through each factor as it applied to my situation. I had not known about the fraudulent deductions. I had discovered them through my own audit work. I had not benefited from them because the expenditures appeared to have been made for Declan's personal purposes, not mine. The erroneous items were clearly attributable to his conduct, and it would be inequitable to hold me liable for a tax gap created by fraud I had uncovered by myself. She told me there had been, for many years, a 2-year statute of limitations on filing Form 8857, but the IRS had issued guidance, and there had been subsequent changes in how the no-deadline treatment applied under equitable relief, IRC Section 6015F. And depending on the specifics of the IRS collection timeline, I might have more runway than the original rule suggested. "You should file now," Patricia said, "before anything goes wrong, before a collection action triggers. Filing Form 8857 puts a formal record with the IRS that you are asserting this relief. It opens a case file. It creates a timestamp." "Will it prompt an investigation?" I asked. "It could," she said. "But if what you've shown me is accurate, an investigation is not your problem. It is his." I filed Form 8857 on a Tuesday in September. Patricia prepared it and submitted it on my behalf. We documented my lack of knowledge, my lack of benefit, and the circumstantial case for attributing the erroneous items to Declan's conduct. We attached a summary of my audit findings. Not the full ledger, but enough to establish the factual basis. The IRS acknowledged receipt within 3 weeks. The case was assigned a reference number. I told no one. I went home that evening, made dinner, watched something on television I cannot now remember, and felt, for the first time in several months, that I was standing on ground I had tested and found solid. Everything else was uncertain. That one thing was not. Declan came home late that night. He smelled of something I could not immediately identify, and later decided was expensive restaurant food. He kissed me on the cheek. He said he was tired. He went to bed. I sat in the kitchen for another hour, in the dark, listening to the house settle. This is the thing about discovering that someone you love has been lying to you. The discovery does not arrive all at once. It arrives in layers. Each layer changes the texture of the previous ones. What you remember from before is recolored, retrospectively, by what you know now. The 5th year of a marriage does not look the same once you understand what was happening in month 26, and month 31, and month 40. Everything is still there, still technically accurate, but it is now lit from a different angle. I did not grieve and collapse. I want to be clear about that. I have seen that version of this story told. The version where the woman finds out and goes to pieces, and I understand why it gets told that way, because the emotion is real and the pain is genuine. But that is not what grief looked like in my body. It looked like focus. It looked like a very specific and quiet determination to understand exactly what had been done to me before I decided what to do about it. By December, I knew most of it. Vanessa Serafine Galvani was 33. She had been working as an event coordinator for a hospitality group when she met Declan at a client event in the spring of the year before I started noticing the invoices, which meant the affair was older than my audit, which meant the recoloring went further back than I had initially estimated. She was not a monster. I want to be clear about that too. She was a person who had made choices I would not have made, in a situation whose full architecture she may not have completely understood. But she was not my concern. My concern was Declan. He was the one who had made promises to me. He was the one who had created a financial structure in which my name, my signature, my tax liability, and my professional reputation were entangled with his conduct. Vanessa wanted to open a boutique hotel, not a large one, a conversion property, 12 rooms, in a building in Fishtown that she had identified and had some notion of developing. The project was called Herondale House. I found this out not from Declan, but from a permitting application I came across while processing some routine city filings for Aldercroft. Herondale House LLC had applied for a commercial conversion permit. The registered agent was Declan Hale. I printed that page. I added it to my ledger. I did not ask Declan about it. 2 weeks later, he asked me to co-sign a loan. He came to me on a Sunday morning when I was sorting through paperwork at the kitchen table. He sat down across from me with a cup of coffee and his reasonable face on, the one he used when he had already decided something and was going through the form of discussing it with me. He said Aldercroft was exploring a new hospitality division. He said there was a pilot project, a boutique conversion property, that he wanted to use to test the model before committing full company resources. He said the acquisition and renovation costs required a bridge loan that made more sense to structure through a separate entity for liability and tax reasons. He said the loan amount was $550,000 and that the lender wanted a personal guarantee from a qualified individual in addition to the business collateral. He said he needed me to co-sign. I looked at him across the table. I thought about the permitting application. I thought about Herondale House LLC. I thought about Vanessa. I thought about the Form 8857 sitting in an IRS case file in the name of Mara Elise Hale, time-stamped September of that same year. I said, "Can I see the documents?" He said, "Of course." He slid a folder across the table. The folder contained a loan agreement from Aldercroft Commercial Banking, the same institution where we held the company operating accounts, and a personal guarantee form. The borrowing entity on the loan agreement was listed as Herondale Hospitality LLC, not Herondale House LLC, a different entity. I said, "This is a new LLC?" He said yes. They had restructured for the pilot project. Standard practice. I looked at the loan agreement. The borrower was Herondale Hospitality LLC, Pennsylvania registration number, registered in October of that year, 6 weeks before this conversation. I said, "Who are the members of Herondale Hospitality?" He said it was majority owned by Aldercroft, with a minority stake held by the project manager to create an incentive structure. He did not say the project manager's name. He did not offer it. I did not ask for it. Not yet. I said, "I'd like a few days to review this." He said that was fine. He poured more coffee. He picked up his phone. The conversation was over. That evening, I went to the Pennsylvania Department of State Business Entity Search and looked up Herondale Hospitality LLC. The registered agent was a law firm I did not recognize. The filing date was October 14th, 6 weeks before. The annual report information showed 2 members. One was listed as Aldercroft Development LLC, with a 49% interest. The other was listed as V. Galvani, with a 51% interest. Majority owner. I sat very still for a long moment. The room had that particular quality of silence that comes when something you suspected becomes something you know, and the transition changes the temperature of the air. Then I got up and went to my desk and opened my personal laptop. I spent the next 3 days doing what I do, which is building the full picture. Herondale Hospitality LLC was on paper a joint venture between Aldercroft and Vanessa, but the loan structure told a different story. Aldercroft was not listed as a borrower on the loan. It was listed as providing a 30% collateral guarantee, which was fundamentally different. The actual borrower was Herondale Hospitality LLC, which was 51% owned by a woman who had no development background, no financial history in the commercial space, and whose only relevant asset was her relationship with Declan. Aldercroft's 30% collateral guarantee was secured against a parcel that I recognized, a land asset we had been carrying on the books, one I had processed the acquisition paperwork for 2 years earlier. Using it as collateral required a board resolution, and Aldercroft's board was, at this stage, 3 people. Declan, his brother-in-law who was a passive investor, and me. No board resolution had been filed. The personal guarantee they wanted from me was not supplementary. Given the structure of the deal, given Aldercroft's limited exposure and Vanessa's thin financial profile, my personal guarantee was the real security on this loan. I was the creditworthy party. My income, my credit history, my financial record, accumulated over a decade of disciplined professional and personal finance, was what this loan was actually being underwritten against. Declan had told me I was co-signing a loan for Aldercroft's new hospitality division. He had not told me that the entity I was guaranteeing was majority owned by a woman he was sleeping with, that the Aldercroft connection was minority and largely structural, or that my personal assets were the primary security mechanism for what was, functionally, a loan to fund his girlfriend's business. This was not a misunderstanding. It was a misrepresentation. A specific, material, deliberately constructed misrepresentation about the nature of the transaction I was being asked to enter. I called Patricia. She was quiet while I went through it. When I finished, she said, "Mara, do not sign anything until we have spoken to a contract attorney." I said I had already identified one. His name was Gideon Prosper, and he worked out of a firm in Center City, and Patricia knew him and trusted him. I had already made an appointment for the following week. She said, "Good. In the meantime, document everything you just told me. Screenshots of the state registration, a written summary of what Declan told you and what the documents actually show. Date everything. Put it in the file." I had already started doing that while we were on the phone. Gideon Prosper was thorough and precise, and had the quality of someone who found contract law genuinely interesting, rather than professionally necessary. He reviewed the loan documents, the LLC registration, the Aldercroft board structure, and my summary of what Declan had represented to me. He asked me several questions about the specific language Declan had used when presenting the loan. He asked whether I had any written communication, texts, emails, in which the hospitality division framing appeared. I did. Declan had sent me a text 3 weeks earlier, before the documents were ready, that said, "Getting the loan docs together for the Aldercroft hospitality project. We'll need your signature once the bank finalizes. Part of the pilot structure." I had screenshotted it the day he sent it. It was in my file. Gideon looked at that for a long moment. "Fraudulent inducement," he said, "is a doctrine that allows a party to void a contract, or seek damages, when they were induced to enter the contract based on a false representation of material fact made by the other party. The misrepresentation has to be intentional, or at minimum reckless. It has to be about something material, meaning something that would have affected your decision to sign, and you have to have reasonably relied on it." He walked through each element. The misrepresentation. Declan told me I was signing for an Aldercroft hospitality division project. The documents showed I was actually signing as personal guarantor for a loan to a company majority owned by an individual with a personal relationship with Declan. The materiality. Would I have signed this loan if I had known the majority owner and primary beneficiary was Vanessa? Gideon looked at me with an expression that suggested he did not actually need me to answer that question. The intentionality. Given the care with which the structure had been arranged, the new LLC, the minority Aldercroft position, the framing of the conversation, this was not an accidental omission. My reliance. I had told Declan I needed a few days to review. My reliance on his representation was exactly why I had not yet signed. "Don't sign," he said. "If they push you to sign under this structure, without disclosure of the full ownership, you have a strong argument that any signature you give was obtained by fraud. But better not to sign at all, and preserve your options." I said, "What if Declan finds another way to pressure me?" Gideon looked at me steadily. "Document the pressure," he said. "Every conversation. Notes with timestamps. If he raises his voice, write it down. If he sends texts, save them. The pattern of coercion becomes part of the case." I went home and started a new section of my ledger. I called it co-signing events. Declan raised the subject 4 more times over the following 3 weeks. The first time was casual. "Have you had a chance to look at those loan docs?" And I said I was still reviewing them, and he nodded and moved on. The second time had more edge to it. He said the bank had a deadline, and the deal would fall apart if the guarantee wasn't in place by end of month. I said I would get back to him. The third time was a conversation I have thought about often since. We were in the kitchen after dinner. He was washing dishes and I was drying them, which was a thing we did because we had always done it. A habit of domestic normalcy that had outlasted any actual tenderness between us. He said, "Mara, I need you to sign this week. I know you like to take your time on things, but this is time sensitive and it is important to me." I said, I'm still trying to understand the ownership structure. He turned off the tap. He turned to look at me.
What do you mean, ownership structure?
I looked up Herondale Hospitality in the state database, I said. The LLC has 2 members, Aldercroft at 49% and someone named V. Galvani at 51%. Who is that? The pause was brief, practiced almost. He had prepared for this question.
The project manager, he said. Vanessa. She's been working in hospitality for years. She knows the conversion space. We brought her on as the operational partner.
On 51%? I said.
She's running the day-to-day, he said. The equity reflects the operational contribution.
So I'd be personally guaranteeing a loan where the majority beneficiary is someone I don't know. His voice changed slightly. Not loud. Declan rarely raised his voice, but there was a compression in it that I had learned to recognize.
You're guaranteeing a project that benefits Aldercroft and builds out a new division. The ownership structure is standard incentive compensation. You're making this more complicated than it is.
I set down the dish I was drying. I set it down carefully because I am not a person who throws things. I'll let you know, I said, and I went to my office. I wrote down the date, the time, and a verbatim summary of the conversation. I noted the change in his vocal register. I noted that he had not disclosed that Vanessa was a personal associate. I saved the entry to my ledger. The 4th conversation happened on a Thursday evening, by text. He sent,
Mara, I need a yes or no on the guarantee. Yes or no?
I wrote in my log, yes or no text received, 7:42 p.m. Thursday. Then I called Patricia. He's pushing, I said. How hard? Hard enough that I want to know what happens if I sign. She thought about this. If you sign, she said carefully, and the loan defaults, you are exposed to the full amount as personal guarantor. Your personal assets, your income, your credit. But if I signed under fraudulent inducement, you'd have a defense, she said. A strong one, on the facts you've described, but you'd still have to litigate it. It would cost money, time, and stress. The better outcome is to not sign a document that misrepresents what you're signing. What if not signing costs me more in other ways? I said. She knew what I meant. She had been my attorney for long enough to understand the whole situation, not just the financial layer of it. She understood that there are points in a marriage when the cost of a particular refusal is not the refusal itself, but everything the refusal makes visible. She said, if you've already done the 8857, Mara, if the relief filing is in, your tax exposure is separated. Whatever happens from this point forward in terms of his conduct, you have that on record. And if I sign, then everything depends on what happens next, and how good your documentation is. I did not sleep well that night. In the morning, I made a decision. Not the decision to sign, and not the decision to refuse. A different decision. I went to see Gideon again. I sat down in his office and I said, if I sign this, what does my documentation give me? He looked at everything I had compiled. The LLC registration, the text messages, my written summaries of the verbal conversations, the loan documents, the difference between what Declan had said and what the documents showed.
If you sign and the loan defaults, he said, you come to me with all of this and we file a claim to void the personal guarantee on grounds of fraudulent inducement. You have the misrepresentation of the borrower's identity, the misrepresentation of your role in the transaction, and a documented pattern of omissions. The question is the lender's knowledge. If the lender processed this loan knowing the actual structure and knowing the primary guarantor, you, was not fully informed, they have exposure too. Banks don't like that kind of exposure.
Would it work?
Nothing is certain, he said, but this is a strong set of facts.
I signed the guarantee that Friday. I signed it, and I photographed every page of the document with my phone before I handed it back. I photographed the signature page, the borrower identification page, and the collateral description page. I added them to my file, and then I waited. I want to explain what waiting felt like, because I think it is the part of these situations that does not get described accurately. People talk about the waiting as passive, as the absence of action,
as the period before things begin. It was not passive. It was active in a different register. It was the experience of knowing something, a specific, detailed, documented something, while occupying a surface life that had not yet caught up with the knowledge. I went to Aldercroft every morning. I did my work. I continued managing the financial architecture of a company that was being slowly looted by its owner. I produced accurate reports. I maintained the protocols I had built. I was professional and competent, and I said good morning to people in the corridors, and I ate lunch at my desk, and I went home in the evenings to a house where the light came in flat across the garden, and the man who had married me slept in the same bed and did not know that I had spent 4 months becoming very precisely dangerous. I had, during those months, done several things that extended beyond the Form 8857 and the documentation. The first was to quietly review all assets held in my name, individually versus jointly. I had, going back to before the marriage, a brokerage account in my own name that Declan did not have access to, and had not been contributed to by any joint funds. I had a small interest in a property my mother had transferred to me during a family estate planning process several years earlier. I confirmed that the title on both was clean, undiluted, and solely mine. I made no new transfers. That would have been inappropriate and potentially fraudulent in the context of what I suspected was coming, but I inventoried what was genuinely mine to begin with. The second was to quietly, over several months, update my professional profile, my licensure, and my relationships in the financial advisory world. I had kept those contacts somewhat dormant during the years at Aldercroft. I began refreshing them, attending a conference in the fall, following up on a few professional relationships I had let lapse, responding to a recruiter's inquiry that, under other circumstances, I would have ignored. I did not accept any offer, and I did not make any promises. I was simply making sure that if I needed to leave, the leaving would have somewhere to land. The third was something Patricia had suggested as a protective measure. Given the IRS filing and the potential for an audit of Declan's returns to produce a tax liability, I had documented, clearly and with supporting evidence, my own independent income, my own tax contributions, my own financial position separate from Aldercroft. The Form 8857 filing was the formal mechanism, but the supporting documentation was the argument. Patricia had advised me to make the argument as detailed as possible. Vanessa's business defaulted 14 months after I signed the guarantee. Herondale Hospitality LLC had obtained the bridge loan in November. They had spent the following spring doing initial construction on the Fishtown property. By the following summer, there were contractor disputes and cost overruns. And by October, the project had stalled. By March of the next year, Herondale Hospitality LLC had missed 3 consecutive monthly payments on the loan. The bank called the loan. Herondale Hospitality LLC was, at that point, an entity with no cash, a partially renovated building as its primary asset, and no operating revenue. Aldercroft's 30% collateral guarantee was worth something, but not $550,000. The bank turned to me. I had known this was coming. Not the specific date, not the specific morning, not the particular tone of the banking representative's voice, but the fact of it, the call, the exposure, the moment when the structure Declan had built collapsed onto the one surface he had calculated would absorb the impact. Yes, I had known. I referred them to Gideon. Declan found out about the default the same day I did. He came home that evening with his reasonable face on, but the reasonable face was working harder than usual. There were lines around it that had not been visible before. He said the situation was manageable, that Aldercroft would negotiate with the bank, that the collateral would cover the bulk of the exposure. I said, "What's the net liability after the collateral?" He did a number in his head. He said something about the bank working with them on a resolution. I said, "Declan, what is the net liability after the collateral?" He said, "Somewhere in the range of $300,000, depending on the valuation." I said, "And my personal guarantee is for the full $550,000. He said, "We'll resolve it." I looked at him for a moment. He had the slightly distracted quality of a man running calculations in real time, and I understood that the calculation he was running was about how much I knew and how much he needed to manage. I said, "I filed Form 8857 in September of last year." The calculation stopped. He said, "What?"
IRS Form 8857, I said. Innocent spouse relief. I filed it with Patricia's help. The application is based on the fraudulent deductions you've been running through Aldercroft to fund your relationship with Vanessa Galvani, which I identified and documented starting in March of last year. The IRS has a case file. It has my documentation. It has a timestamp from 14 months ago. He stood very still. The house was quiet except for the sound of the radiator in the hallway.
Mara.
I also have a fraudulent inducement claim on the personal guarantee, I said. You told me I was signing for an Aldercroft Hospitality Division project. The borrower was a company majority owned by your girlfriend. You omitted that material fact. I have the text where you described it as an Aldercroft project. I have the state registration showing the actual ownership structure. I have my notes from 4 conversations in which you described the loan in ways that were inconsistent with the documents. Gideon Prosper has been briefed on all of it. He said my name again, a different way this time, quieter. I said, I'm going to go stay with my sister for a while. I think you should call your attorney. This is the part where I could give you the confrontation in full, the back and forth, the attempts at explanation, the moment when what he thought was a controllable situation became something else entirely. But I am not going to give you that, because it is not the part that matters. The part that matters is everything that came before, the 14 months of documentation and professional consultation and deliberate, unhurried preparation. The confrontation was just the reveal. The work had been done. I stayed with my sister for a week. When I came back, I moved into the guest room. We lived like that for 2 months while the lawyers handled the preliminary filings. It was not comfortable. It was not meant to be comfortable. It was a transitional arrangement, and I treated it as such. The divorce proceedings opened in January. The IRS investigation of Aldercroft's returns, which had been proceeding quietly since my Form 8857 filing, prompted an examination of the underlying returns, became formalized in February. An IRS examiner contacted both Patricia and Declan's tax attorney. The examination was specifically focused on the years I had documented, the deductions for Harrogate Interiors and the other vendors, the lifestyle expenditures coded to business budget lines. My innocent spouse relief application was evaluated against the 3-part test under IRC Section 6015B. First, the erroneous item, the fraudulent deductions, was on the joint return. Second, the understatement was attributable to Declan's erroneous items, not mine. Third, I did not know and did not have reason to know about the erroneous items when the returns were signed. This was the key element, and it was where my documentation earned its value. Patricia had argued in my application that as a finance professional reviewing company records, my discovery of the anomalies in March of the filing year and my subsequent documentation and consultation was evidence of the initial absence of knowledge. If I had known, I would not have needed to investigate. My investigation was the proof of my ignorance. The IRS examiner, reviewing the timeline, the documentation, and the fact that I had filed before any IRS collection action, agreed. Innocent spouse relief under Section 6015B was granted. The tax liability, interest, and penalties attributable to the fraudulent deductions were assessed against Declan individually. My joint liability for those amounts was released. The personal guarantee was a separate fight. Gideon filed a claim in the civil court, asserting that the personal guarantee was voidable on grounds of fraudulent inducement. The argument was direct. I had been given materially false information about the nature of the borrower and the ownership structure of the entity I was guaranteeing. The misrepresentation was intentional, material, and relied upon. The bank had processed a personal guarantee from a party who was not fully informed of the transaction structure. The bank's attorneys, on reviewing the documentation, made a pragmatic calculation. A disputed personal guarantee, with documented evidence of misrepresentation by the borrower's affiliated party and a potential exposure for the bank's own role in processing a guarantee under those circumstances, was not a fight they wanted to take to trial. They negotiated. The settlement reduced my personal guarantee exposure from $550,000 to $47,000, structured over 18 months, which was substantially covered by a portion of the marital asset division in the divorce settlement. I want to be specific about this because it matters. The settlement was not a clean zero. I paid something.
The fraudulent inducement claim reduced my exposure by approximately 91%, but it did not eliminate it entirely. Real outcomes are not clean zeros. They are outcomes that you can live with, outcomes that leave you intact and functional and free to move forward, which is different from outcomes that feel like justice in the narrative sense. The divorce was final in October. In the asset division, the marital home went to Declan, who purchased my interest at appraised value. The Aldercroft equity I had accumulated over years of work, documented through board resolutions, was valued and divided. My individual brokerage account and my interest in my mother's property were confirmed as separate assets and excluded from the marital estate. By the end, I had enough to start. I am aware of how that sounds. Enough to start. After 11 years and a CFO title and a company I had helped build from 20 people to 40, after the architectural work of designing a financial system for a business that ran because of what I had put into it, after all of that, I had enough to start. I thought about that a lot in the winter after the divorce. I thought about it in the way you think about something that has the potential to become bitterness, turning it over to examine its edges, deciding whether to keep it or put it down. I decided, mostly, to put it down. Not because I was not angry, I was, but because bitterness is expensive, and I had already spent a great deal of the previous 2 years on things that were expensive. I was not interested in continuing the expenditure. In January, 6 weeks after the divorce was final, I accepted a position as CFO of a development company called Edgemont Capital Partners. It was larger than Aldercroft. The work was more complex. My compensation reflected what I was actually worth rather than what a spouse negotiates for himself. On my second Monday there, I set up a folder on my new work computer. I labeled it Documentation. I added a subfolder labeled Initial Baseline. I recorded my starting conditions, my accounts, my assets, my agreements, my liabilities. This is what I do now. I document my starting conditions. Every time, every place. Because what I learned from all of this is not that people will lie to you, which I already knew, or that marriages can fail, which I had always understood theoretically. What I learned is that the value of a paper trail is not in what it documents after something goes wrong. Its value is in what it disciplines you to notice before anything goes wrong at all. If I had kept that ledger from the beginning of the marriage, I would have been building my case, and my clarity, from year 1 instead of year 5. I would have noticed sooner. I would have been less surprised by the specifics, even if not by the general betrayal, and I would have had more time to do what I did. Deliberately, methodically, without anyone watching, which is to become exactly the person I needed to be for the next part of my life, before the current part was finished. On a Thursday in March, 1 year after the creditor call, I received a letter from the IRS confirming the final disposition of my Form 8857 case. My relief had been processed in full. The matter was closed. I was at my new desk when it arrived. The office at Edgemont has a window that looks out over Market Street, which is not as quiet as the Chestnut Hill Garden, but I have gotten used to the different kind of noise. I read the letter. I put it in my documentation folder behind the divorce decree and the guarantee settlement agreement and the original Form 8857 acknowledgement. I straightened the papers in the folder. Then I went back to work. 3 months after the divorce, Declan left Aldercroft. The company went into a restructuring process that resulted in a sale of the primary operating assets to a firm I had consulted for briefly in my first year in the industry. I have been told the sale went reasonably smoothly. I did not follow the details. Vanessa's Fishtown project was eventually finished by new investors, after the bank workout and the Herondale Hospitality dissolution. The hotel opened 18 months behind schedule, in a market that had changed enough to make the original pro forma obsolete. It operates, but not profitably. I know this because the address still comes up in city permit records, and I have a professional habit of knowing things about properties in the market I work in. I have never spoken to Vanessa directly. I do not intend to. Whatever she and Declan built together and lost together is, in the plainest possible terms, not my business. Patricia and I have lunch 4 times a year, at a place on Walnut Street that has good fish and excellent natural light. She always orders tea and never finishes it. On the last occasion, she looked at me across the table and said, "You know what made the difference, don't you?" I said I had some ideas about it. She said, "The timestamp." She was right. The The Form 8857 was filed in September. Vanessa defaulted 14 months later. Those 14 months were not accidental, and the timestamp was not incidental. The entire case for my relief, both the tax relief and the fraudulent inducement defense, rested on the fact that my knowledge and my actions preceded the damage. I knew before the collapse. I acted before the collapse. When the collapse came, it did not find me standing in its way. It found me standing a few steps to the side, with a folder of documents and an attorney on retainer, and a very specific piece of IRS paperwork that said, in the formal language of the Internal Revenue Service, that I had never been part of what he built. I paid the check. I left a good tip. I walked back toward Market Street with the March wind off the river cold on my face, and I thought about the ledger I would open when I got to the office. Just to check. Just to know where everything was.